Now, recently, I had the pleasure of speaking with one of the leading experts on insurance for the past several decades. Among his many roles in the industry, he served 18 years as economist at the Insurance Information Institute, more than 9 as its president. He is now Clinical Associate Professor of Finance and Director of Risk and Uncertainty Management Center at the University of South Carolina's Moore School of Business. We had a broad discussion about a wide range of topics, from COVID-19 to climate change, from disruptive technologies to talent acquisitions. Here are the highlights of our talk. Bob, welcome to the Pulse.
Very glad to be here, Ed. Thanks for having me.
On the strength of your visit, we received several questions from our audience. I'll sprinkle them throughout our conversation today if that works for you.
Absolutely. I look forward to them.
Let's start with a look back at this year, and certainly it's been a long one, with so many catastrophes already. But I'm curious to get your insights on one that started back in March of 2020. Of course, I'm talking about COVID-19. From your perspective, what impact has the pandemic had on the insurance industry from an operational perspective and an underwriting perspective?
You know, the relationship and the impact of the pandemic on the property casualty insurance industry can really be divided into two stories, in much the same way that it can with the overall economy. We had the immediate impact that began in March of 2020, when this country and really the global economy experienced a collapse of proportions that we had really not seen in generations. At that point, there was so much uncertainty as to what the trajectory of the pandemic would be from an epidemiological standpoint, what the impact would be from an economic standpoint. And so as we made our way through 2020, actually relatively quickly, we began to understand what the economic impacts would be. As we saw global shutdowns, governments, we saw people fearful of travel and the economic impact of this. But early on, by the summer of 2020, I think we began to see, and as I discussed, even that at that stage, that very early stage, that we were poised for what I call the V-shaped recovery. And in this case, V stood for vaccination. So I think we could see fairly clearly through to the end of 2020 and early 2021 that the economy, the global economy, would be led out of the COVID-19 pandemic by the very rapid rollout of vaccines on an unprecedented and global scale. And that happened. So then we were led into 2021, where I actually think there was a great deal of uncertainty that nobody anticipated, certainly in the early days of the pandemic. And what we're looking at right now is, rather than, there remains an epidemiological phenomenon, certainly in many countries, which have not even had the opportunity to have a single dose of vaccine at this point. That's really billions of people in most of the world's population. Nevertheless, in those parts of the world that generate most of the global GDP, we've seen vaccination programs rolled out. Where we have seen the impact of the COVID-19 pandemic pivot in terms of the relationship to many industries, including our own, is, for instance, areas such as inflation on a global scale. We've seen scarcities driven by supply chain problems on a global scale that have been ongoing really throughout 2021 and will be manifest through 2022 and to some degree into 2023. So I think that many people believed once we got on the other side of COVID with a global rollout of vaccines, pretty much we'd go back to normal by the summer of 2021. And in fact, we thought we were there. And it turns out that was a false call on everyone's part. We thought we were back to normal. That lasted a couple of months. So here we are right now in the property casualty insurance industry, having made it through COVID. I think much better, relatively unscathed here in the United States in terms of what the original loss expectations were going to be, which were in the many, many tens of billions of dollars, even $100 billion plus in some instances. In terms of the premium revenues that would be lost, those were relatively minor in the greater scheme of things and were definitely temporary. But with us this year and into next are going to be cost pressures, for instance. So if you look at the increased cost associated with repairing homes and cars and businesses and people and so on and so forth. This is something that's going to linger and ultimately could be more costly for the industry on a global scale than the actual pandemic itself.
Thank you. Well, I'd hate to think about the next pandemic, but have we learned anything from the way we've handled COVID that will help us navigate a similar crisis in the future?
Well, Ed, I hate to think about the next pandemic too. So if you read epidemiological literature on this, we see these large-scale pandemics tend to operate on 50-year return cycles. So what we are learning today, to some degree, we have to understand really will not be all that useful to pull off the shelf in the year 2070 or 2080. Okay, the circumstances will be very different. Technology and science will be very different. The global economy will be very different. What I think the main lesson is for this industry is the same lesson that we have learned through record property catastrophe losses caused by global catastrophes, or we learned from 9/11 and other sorts of events, is the importance of this industry remaining financially strong, stable, sound, and secure, which allows us to be resilient really under virtually any circumstance, including those circumstances that are truly unprecedented, whether we go back 25 years ago, which initiated this era of mega catastrophes with Hurricane Andrew, or we talk about events like 9/11, or we talk about the financial crisis, totally a man-made event, or we talk about what happened most recently with COVID-19. The common thread running through all of those is this is an industry that is extremely well capitalized. It is very tightly regulated, but it is conservatively operated. And those principles on a global scale get us through time and time again through the unanticipated events that we see every couple of years. So some of them will be man-made. Many of them will be man-made. Again, over the past 20 years, when we look at 9/11, entirely a man-made event. When we look at the global financial crisis, entirely a man-made event. Even COVID-19, to some extent, was a man-made event. I'm not talking about the origination of the virus itself. I am talking about the global reaction in terms of shutdowns, which were truly unanticipated in the sense that, or I should say unprecedented in the history of pandemics, at least over the past century. So that resilience, which principally stems from the financial strength of this industry and its sort of conservative approach to underwriting and its adherence to the four corners of the contract, paying all those claims that we are legally required to pay, but sticking to the terms of contracts despite regulator and efforts by critics to get us to move beyond that. If we move in that direction, it would be very dangerous. So to the credit of the industry, by sticking to our knitting in terms of our contracts and doing what we do best and maintaining those strong financials, we are doing our customers a great service, and we're actually doing the global economy a great service.
All right, thank you. Another still emerging risk is climate change. According to NOAA, the frequency and extreme weather events is increasing. And in fact, as you know, in 2020, we set a new record, $22 billion loss events. And during just the first 6 months of this year, there's already $8 billion of weather and climate events. That's even before hurricane season. So on this topic, we received a couple questions from our audience. What do carriers have to do to survive and thrive through increased frequency and severity of cat losses? And what do companies need to focus on themselves to address climate change?
Well, let me start with the survive and thrive question. It may surprise many people for them to hear me say this, but actually the insurance industry is doing a very, very good job of this. Okay, adapting to variability and volatility in the climate is in the very DNA of the property casualty insurance industry and reinsurance industry. We've been doing actually successfully, not just for the past couple of years or past couple of decades, but quite frankly, in the case of some insurers, for centuries. This is an industry that has moved into property risk exposures on every corner of the planet. for every type of property that exists and has done so successfully. And how do I measure success? In the property realm and in the property catastrophe reinsurance realm, we see the industry expanding both in terms of top line in terms of dollars. We see it expanding across the world in terms of exposures, obviously through the developed world and the advanced economies, but increasingly through economies that continue to develop and play an instrumental role in parts of the world like Asia and Latin America and Africa and helping them develop. And all at the same time, being able to do this by providing insurance in a way that is affordable to the businesses and individuals who need it. And also, the industry is clearly doing something right because it continues to be able to attract substantial amounts of capital despite these record number and cost, so record numbers of disasters on a global scale and the record cost of these disasters on a global scale. If the industry were doing something wrong, in other words, it were getting wrong consistently, the analysis of the data that is coming in associated with property-related losses, and we're not pricing those risks appropriately, the investment world in general would have long since abandoned the property catastrophe insurance and reinsurance business, and rightly so. But the reality of it is that capital continues to be attracted to this business, and it also continues to be attracted to this business in the form of insurance-linked securities. So collectively, globally, there is more capital today backing property risks than there ever has been in the history of the insurance industry. And that continues to grow. You, in fact, see that in 2020, we set a new record in terms of catastrophe bond capital outstanding. That record is already set to be shattered in the very beginning of the fourth quarter of 2021. And what, again, that suggests is that this industry is doing a fantastic job at assessing these risks, providing the products and the risk mitigation services that businesses and individuals around the world need in such a way that the products can be priced in a way that is affordable and continue to attract new capital as these risks continue to intensify. Now, that does not mean that there is not an insurance gap out there. There is. There are far too many businesses around the world have too little or no insurance at all appropriate to the risks that they face. And that is certainly true for many individuals. We need look no further than our own back door here in the United States with a recent event like Hurricane Ida to understand that probably a third, 40% of the economic losses will go uninsured from that particular event. And we certainly need not to go very far and look not far beyond our own borders and look at a country like Haiti, for instance, which has suffered two devastating earthquakes, certainly not a matter of climate change, but devastating tropical events there as well. And to see how destitute a country like that is just a few hundred miles away from our own borders. So there's a lot of work to be done in terms of bringing the resilience that we see in the United States, Western Europe, Japan, increasingly places like China, and bringing them to the rest of the world so that the rest of the world, much of which is more vulnerable to climate change than we are, will have the opportunity to bounce back the same way that more advanced economies can.
Good. All right, well, let's start talking about underwriting and data. The need for actionable data to inform the underwriting process has never been greater, and the sources of valuable data have never been more desperate. With increasing interconnectivity, we're seeing a growing need for more and better and even timelier information and correlation across data sources. Yet companies continue to protect proprietary data as part of their secret sauce. Our audience asks, what concerns do you have about the credibility of big data as companies embrace it within their premium calculations? And what are the imperatives for the industry to work more collaboratively to gather and share relevant information across the ecosystem?
Yeah, I mean, there's a lot of questions in there, Ed. And the good news is there's more data than ever. The bad news is that there's more data than ever. And what do we do with that data? I like to refer to the insurance industry as the original big data industry. I mean, we were around analyzing data for centuries before Google even came into existence. Okay, and so again, that is part of our DNA. It's part of how we've remained resilient for so long, and how we will remain resilient and relevant in the future. Now, the question that we face is really no different than virtually every other industry on the planet faces today. We are all deluged with information. How do we discern what information is good, what information is not as useful to us, and how do we employ that data in a manner that is going to be economical for us and provide the greatest value to shareholders and to provide the greatest benefit to our customers and allow us to continue into the future with a business model that is going to allow us to meet the risks of the future. I can't give you all those answers today because the data revolution is ongoing at an exponential pace, and it's I think that even the largest companies like Google and Facebook and others on the planet really struggle with this. And in fact, if you follow the headlines, those companies are under attack for the use of their data and how their data are employed. They are seeing increased regulatory scrutiny associated with how the data are employed. So, but with all that being said, I think I have faith that we will, over time, by employing the right talent, we'll be able to sift through the data that are important, that are predictive of loss for us, including the new categories of loss that we are paying more and more attention to, such as cyber-related losses, for instance, or losses that are more difficult to measure related to reputation or ESG types of risks. And we will learn by doing, just as we always have. I always like to reflect with my students or others when I'm making a presentation and talk about the fact that there was a time when the first insurer ventured to write an auto insurance policy. There was a time when the first insurer ventured to write a policy on a satellite in space. There was a time when the first insurer wrote a policy on something that we would call a train. And so there was a first for everything. And now when we look at, for instance, we're probably at the very beginning of space flight for the average citizen. And so we've seen the race to billionaires to space, but eventually that's going to be democratized. So Ed, maybe by the time you and I are retired, we'll be able to go up there and, Jeff Bezos won't be with us, but we'll be able to buy a seat on something that's manufactured on some battery powered rocket ship made by Elon Musk. I really hope that's true. But what we do know is that no matter how it gets into space, it's going to be insured by the private property casualty insurance industry. There's not a lot of data to begin with. That much is true. When we began underwriting aviation risks, we brought marine underwriters over to do it. And so we continue to learn by doing. And I think the biggest area where we're seeing that right now is cyber, which you could argue we're probably 20 years into the era of what we might call modern cyber underwriting. At the same time, we're very much at the tip of this iceberg. I mean, our understanding of cyber risk today is pretty much Stone Age, okay? And we are going to have to evolve and learn by doing. But I'm confident that by prudently committing capital and resources, meaning resources in terms of the data analytics and the talent that's necessary to analyze this information and collect this information, we'll eventually get it right. Will there be a cyber 9/11 someday or a cyber Katrina? Absolutely. It's guaranteed this will happen. But will we be able to apply the same principles that have allowed us to be resilient through financial catastrophes of every imaginable sort over the past several centuries? The answer to that is absolutely yes. So I'm ever the optimist on this, Ed.
Well, thank you for touching on cyber risk. If we have time, I want to get back to that. But I want to talk about new technologies. We've been hearing the term disruptive technologies for some time. Even AAIS developed a blockchain platform supporting secure and transparent information sharing within our industry. We built OpenIDL in collaboration with carriers and regulators and other stakeholders, and it's now a Linux Foundation project. Some see application for OpenIdeal across the entire ecosystem, so that could be disruptive, perhaps. What disruptive technologies do you see having the potential to affect the industry in the coming years?
Well, Ed, a couple of comments here. First, let me answer your second question first. In terms of, I think, truly disruptive technologies, I think that increasingly the user-based insurance, so in other words, UBI, but what I mean by this is this would not be confined to property insurance. We're talking about user-generated data coming directly from vehicles, homes, businesses, our own human body that will be used directly for the purposes of underwriting, again, means of transportation, of property, as well as life insurance and health insurance in the future. I think that generally when we look at how insurance has been underwritten historically, many of the data that we use provide sort of an indirect measure of risk. We find ways to correlate such things as your individual credit score or insurance score with the potential frequency for automobile losses. Wouldn't it be better if ultimately we're measuring real time your driving behaviors, and then we can correlate behaviors such as heavy braking activity or propensity to drive at night or proportion of time that one is speeding with actual accidents and claiming related behaviors? I think we all agree that that sort of data and information is probably preferable, and that's where we're going. So what that means is that we are at the very early stages of unleashing a torrent of data upon the insurance industry and many other data vendors and providers, the likes of which the world has never seen. We're talking about individual vehicles essentially throughputting trillions of bytes, basically terabytes of data in a given day. Much of that is not particularly useful, okay? But some of it is. So we're going to have to sort the wheat from the chaff here. But that's the way that things are going across, whether we're talking about property insurance, life insurance, or health insurance. Because the reason why this is superior is not just because the data is more directly tied to the actual claiming behavior or the loss behavior of the individual. It's that it creates a new relationship with the customer in the sense that rather than just receiving a bill every January for my auto insurance, here it is. If you didn't have any claims, maybe your premium stayed the same, maybe it went down a little bit. Instead, during the course of the year, we can provide real-time feedback on your driving behaviors and tell individuals how much they could save if they were only to reduce the number of times they speed, or if they were to reduce the number of hours they drive at night, or if they reduce the number of times that they engage in heavy braking activity and rapid deceleration. Through that, not only we save them money, we perhaps reduce injuries, we reduce property damage, we reduce deaths. And this is true whether we're talking about auto insurance or commercial auto exposures or even property exposures where we can monitor real time for hazards within businesses or households. And then certainly in the realm of life and health insurance, which I also teach, we're seeing that same kind of revolution there. Real-time feedback to individuals suffering from many types of conditions or who might potentially suffer from various conditions, being provided feedback in real time so that they can reduce morbidity risk, in other words, the risk of injury or illness, or reduce mortality risk, the risk of death itself. And so I think that it's very, very exciting prospect. And I think that if we were to fast forward 20, 25 years from now, I think that the majority of underwriting with respect to certainly motor vehicles and I think life insurance underwriting will have moved firmly into that direction.
All right, Bob. Well, you've addressed both data and new technologies, and you did mention cyber risk. So I think I need to go there now. You know, with these disruptive technologies and with more data comes the very real risk of cyber crime. So insurers are doubly concerned as they seek to provide insurance coverage for cyber risk. At the same time, they face the risk themselves. In your estimation, how has the industry responded to cyber risk, and how will the cyber risk market evolve?
I think that cyber risk now. I think we're actually having to reevaluate how we approach it. As I mentioned, I mark the beginning of this modern cyber insurance market with Y2K, so about 20 years ago. But I think that we've moved in the last couple of years into a new realm, and it's time. And insurers are beginning to sort of step back and reevaluate what the situation is. And I think that major hacks such as SolarWinds, but also the proliferation of ransomware attacks, which are pretty much like stick-ups. I mean, this is what's happening. Instead of walking into the bank with a gun, you walk into the bank with some malware, and pretty much someone's got to pay. They've got to pay, or they're going to be financially clobbered in the process. And so we've seen insurers, make the decision that, they'll offer cyber coverage. But in the case, for instance, of ransomware, very often insurers are simply paying the ransom because that's the cheapest, most expedient thing to do in terms of getting the business back to operation. Many people have a problem with that. So I think we're going to move. We're going to have to invest much more heavily in preventing these types of crimes from occurring to begin with. So again, we're very much in the infancy on this particular issue. So just in the way as banks long ago, when most transactions were handled in cash, you'd have an armed guard at the door. All right, more investments are going to be made upfront in risk mitigation to prevent these attacks from occurring to begin with. So one of the interesting things I think cyber is it will lead the way, or maybe even lead the way isn't quite the right word, because when we think about the P&C insurance industry, we've led the way in terms of risk loss prevention for many decades, whether it's workers' compensation and many, many other areas. Cyber, I think, lagged behind a bit there. So I think what we're going to see is the preponderance of the investments being made at the front end to prevent the attacks from occurring to begin with, and then with insurance on the back end to cover any of the residual costs, including reputational costs, that might occur. And this is going to be a nonstop battle. And to some degree, we have a much easier time battling climate-related issues because we have a much better understanding how the climate is going to behave versus some institutional or state nefarious actors around the world. Who are they going to attack? How are they going to attack? Do we have the tools to prevent that attack? Are we even going to know we're being attacked? When a hurricane happens or an earthquake happens, we know it. As we found out time and time again with these many types of cyber attacks, such as with SolarWinds, the enemy is present for months before we even know it. And then when it's something like a ransomware attack, they're there and we're caught by surprise. By that, I mean, generally speaking, the individual clients that we have. So, but again, I think that this will become a risk that is ultimately manageable. And what we will begin to see is while more and more insurers have been tiptoeing more and more into the cyber market over the past decade or so, I think that will continue, and insurers will feel more and more comfortable writing higher and higher limits associated with this. But those limits, of course, will come with the caveat that there needs to be very, very substantial investments on the front end to reduce the frequency and severity of these events on the back end. But again, I think that this being the infancy of the cyber era, there are certain events that have yet to occur. And I mentioned, a cyber 9/11, or we hear about silent cyber, or, the cyber Katrina sorts of events. And at some point, these will occur. So a good example, the Colonial Pipeline attack, that ransomware attack that we saw earlier this year, where there was no gas in large parts of the United States as a result of that particular event. We had some meat producers, for instance, attacked around the same time. We could easily envision a situation where a very substantial infrastructure attacks do occur that affect our very fundamental ability to exist as a cohesive society. And that will be something that truly stresses every industry, including our own.
All right, well, let's move on to another topic. I'm not sure if it's more predictable or less predictable, but legislation, regulation, and litigation. Every insurance organization has to deal with the outcomes from government agencies and the courts. What are the biggest issues insurers should take into account as they plan for the future?
The issue of a tort system run amok has been a concern of this industry really since the 1970s and the 1980s. And while there have been some successes in terms of obtaining not only tort reforms, but also reforms at the level of the state judiciaries, this is a multi-headed hydra that keeps coming back and back and back. And the reason for it is that the trial bar in this country is the best funded, best organized special interest group in the United States, bar none. We have more lawyers per capita than any other country on earth. And we have laws that encourage the filing of lawsuits and do very little to actually dissuade it. So, for instance, you could file the most frivolous lawsuit in the world, and the individual is still going to have to pay to defend themselves. And even if they prevail, the cost is still potentially pretty significant. So there are no immediate solutions at hand here because let me give you an example. So, across the political spectrum, even in states that are dominated by individuals that are professed to be conservatives in many southern states, and this state included South Carolina, the legislature still tends to be dominated by trial lawyers of both political persuasions. So there's pretty much only one thing that state legislatures seem to agree on is that they will be dominated by trial lawyers, and no law will be passed except with a great difficulty over great lengths of time that will abridge the economic opportunities available to those trial lawyer members of legislatures all across the United States. And if you look at the various trade associations around this in this industry and in others, you'll get the U.S. Chamber of Commerce. This is recognized as a universal problem. So the fundamental solution to fixing the tort problem in the United States is thinking about who you elect. At the end of the day, why do people continuously go to the ballot box and elect trial lawyers by the droves when the problems facing this country have little to do with things that trial lawyers can actually solve? We've got problems in technology. We talked about cyber-related risks. We've got problems in the healthcare system where we have very few healthcare professionals in the system. We have problems with the educational system in this country, yet we have very few individuals with that kind of background who represent us either at the local, state, or the national level. So, I hope to, I wish I could tell you this was something that was in the hands of the P&C insurance industry to solve. So the best thing that we can do as an industry is work as hard as possible to defend the integrity of an insurance contract. So the best example of that recently, of course, is with COVID. And the efforts early on, where there were thousands of suits filed against the industry in an effort to get insurers to pay business interruption claims because of government mandated closures from COVID, or alleging that the presence of COVID itself somehow created physical loss or damage, destruction of covered property. The industry argued, I think, articulately early on and forcefully that the contract simply cannot be interpreted in that manner. And within a few months, courts around the country began to agree. It soon became precedent all the way through the federal appellate courts. So that's where we are today. And today there are almost no cases being filed, or at least in the business interruption arena. The industry prevailed ultimately back in the era of Katrina, and after that with Sandy, with respect to wind versus water related issues. That was very important. So, well, as an industry, we, along with every other industry, we cannot do this alone, do need to support tort reforms where and when we can, and support the right people being elected to state legislatures and into Congress where and when we can. We really have to fight at every opportunity in every corner of the United States where the contract itself is coming under assault. If we cannot hold to the four corners of the contract, we cannot price the coverage appropriately that we are offering, and we are ultimately going to misprice or under-reserve the coverages that we are offering, and ultimately that could lead to one of the largest challenges that the industry has had. And in fact, that has historically, over the last several decades, been a much larger challenge than the climate risks that this industry has faced.
Well, Bob, let's move to a topic that's been, I'd say, the industry has been challenged with at least the last decade, but that's the talent gap, as talent acquisition and retention remains a major concern. And I think it's been heightened, not just in our industry, but obviously all industries over the last 6 months. What's your perspective as a professor of risk management? Are companies adequately adapting to today's workforce? And what's attracting the next generation of professionals to our industry?
Right. So could the insurance industry do more, as broadly defined, to attract top talent? Absolutely. I see it every day here. We train students here very holistically in the practice of enterprise risk. And that means that they have opportunities, not just in the insurance world, but they have opportunities, for instance, in the banking world, where risk assessment is a very important skill as well. It's also a very important skill in many corporations. So we see our students go off not just to insurers and brokers, but to banks and to consulting firms and to manufacturers, to government agencies. So what I think the industry needs to understand is that they are competing for a scarce resource, and that is a generation of student, and a student, at least here at this institution, who's been trained broadly in the assessment and the analysis of risk. Most of our students couple their studies of risk management and insurance with a degree in finance or accounting, and typically also with now a concentration in data analytics. So their skills are readily transferable, and they are prepared to use them, of course, where they feel that their prospects are going to be the best, of course, for them over the long run. So what can insurers do? If I were to outline one or two things, what could insurers do to make sure that they have the opportunity to have a front row seat to the best talent that is graduating from American universities today? Okay, number one is just don't show up at the talent fair at the end of the student's senior year, parachute down, and expect that you're going to get the best talent. I will tell you that my best students had job offers in hand the first day they set foot on campus of their senior year. Okay, that means they already know what they're going to do when they graduate next day by the first day of class this August. And those are students who've had one or two internships with companies. The companies have already demonstrated an investment in them. They've given them some sense of what the company culture is like. They've given them a sense of how they will help their career mature, how they will be mentored, where they can go over the next several years. Those are where the best students, the top students are going. Now, there are other students who are still strong students, but they're open-minded as to where they will go. Again, don't just land at the talent fair. Stay engaged throughout the year. So the best thing that a company can do is it can be on campus, say twice a year, actively speaking to students in a classroom setting or at some other sort of setting where there is an opportunity to interact one-on-one. Provide internship opportunities would be your number one key to attracting the top talent. Potentially providing scholarship opportunities to some students so that you're top of mind associated with them as they seek to find their way in the world afterwards, and find other means of engagement as well. So, for instance, some companies sponsor contests of various sorts where student teams are formed. But at any rate, if you don't have a regular presence, then it can be a case of out of sight, out of mind, as students are considering where they are going to go. And so those are my kind of, if I were to consolidate my recommendations, that's where it would be: is stay committed, don't pop in, don't pop out, remain committed to organizations, of course, that have, like our own, that have significant risk management insurance programs, but at other institutions. And of course, there are students who are going to be found outside of the business schools, and many individuals who have been successful in the industry come from outside, don't have degrees in business, and certainly perhaps had careers elsewhere. So keep them in mind also.
Thanks, Bob. That's great advice and important advice for our industry. Well, let's switch to this year's financial results. So we're closing in on the end of 2021. That's budget season for many insurers and reinsurers who will also be projecting their financial results for this year. Aside from extreme loss activity, what other factors are affecting financial results?
Well, we've been through a lot of financial market volatility over the past nearly 2 years now. And of course, we saw with COVID, we saw the S&P fall by about a third in the matter of a couple of weeks. Along with the other major indices, we've seen interest rates plunge as the Federal Reserve sought to lower interest rates to rock bottom levels to help stimulate the economy through accommodative monetary policy. And now, as insurers are looking ahead into 2022, they're looking at the potential for interest rates to rise a bit as higher inflationary expectations take hold, and the expectation that the Fed will begin to raise interest rates maybe 2023 or even 2022 as they look into the year ahead. So how do they want to structure their fixed income portfolio given the anticipation of higher interest rates going forward? So higher interest rates are ultimately good for large institutional investors such as P&C and life insurers, along with pension funds and hedge funds. But it's a little bit tricky when we're migrating from a low interest rate environment to a higher interest rate environment, or vice versa. So that's going to be top of mind there, and that is a concern. Other concerns that are going to be out there, we already discussed the issue of torts. Torts are going to remain a big issue. The regulatory environment is another one. We're in an environment right now where there is a fair amount of activism coming down from the federal level, but also at the state level, essentially trying to restrict the types of underwriting criteria that insurers can use, even on criteria that we have used for many years in the past, such things as credit. I think that another thing to look at on the regulatory front is going to be this battle of how to manage artificial information type technologies that increasingly insurers are going to rely upon, not only to speed up the kind of business to business sort of transactions that occur day to day within an insurance organization, but also to improve the consumer experience. But at the same time, we've already seen a number of companies come under attack for the black boxes that AI is quite famous for already. Because with traditional algorithms, an insurer could perhaps share confidentially with a regulatory body. Well, here's what we use. Here's the data that back up the actuarial science that show that variable A is correlated with frequency and variable B is correlated with severity. And this is why we should be allowed to use them to this degree in our rates. They're actuarially justified. We're moving into a realm right now where insurers could invest substantial sums in these kind of machine learning, artificial intelligence type algorithms. And the insurer itself has developed the algorithm, but the algorithm potentially is subject to various biases. And the question is how will regulators address these? Is it through what is known as, the regular auditing of these algorithms? Do the regulators themselves even have the right staff to be able to do these? Do the insurers themselves even understand what is in their own algorithms? We've seen large companies, even Amazon itself, roll back some of the AI technologies it was using, for instance, for the selection of talent, because it realized that its own biases were embedded in the AI algorithms themselves. So if Amazon can't quite get it right, there's no way we're going to get it right first time around either. So I think that's one of those fascinating challenges, and I think we're going to have to find a new way to coexist with our regulators with this with new types of analytical mechanisms that we have for the tsunami of data that we discussed earlier on, Ed, which is going to be a very much a challenge for us to process.
Well, I'd like to follow up on that, those financial results, and ask you if you have any predictions. I mean, what sectors do you see being most negatively impacted by the events of 2021, and where do you expect to see some positive results?
Yeah, so if we look at 2021 compared to 2020, so we're seeing, for instance, the recovery of a lot of lost exposures in key lines, such as workers' compensation. So workers' comp premiums written declined by 10% in 2020 as a result of the 22 million people who lost their jobs and a reduced payroll exposure. Most of that will be recovered by the first half of 2022. We've still got about 5 million jobs that have yet to be recovered, but payrolls are expanding at a healthy clip because wages are rising. So workers' comp top line will recover at some point next year. It's done a lot of its recovery today. Personal auto, we saw about a $4.5 billion decline on the top line last year because of the rebates and givebacks, discounts insurers provided last year, result of people driving less. Virtually all of that will be recovered this year as we saw driving behaviors more or less get back to where they were prior to the pandemic. The other economically sensitive lines, such as inland marine, that saw premium declines last year, most of that will be recovered by the end of this year or next year. Where I think will be impacted to some degree adversely, if you look at the going back to private passenger auto, if you've driven past your local friendly auto dealership recently, you'll notice that the lot is largely empty. Okay. You will see that there are a lot of construction jobs and other sorts of things that are taking a lot longer to do than would otherwise be the case. And so these supply chain issues are going to vex the insurance industry in the sense that it's going to slow the pace of new insurable exposures relative to what we would have expected. Again, one of the things we talked about earlier on is the way that we are interfacing with the pandemic. Earlier on, it was purely an epidemiological issue and an immediate economic impact. Now we're dealing with those longer term economic impacts, and that is going to impact the P&C insurance industry. And so will the monetary policy and fiscal policy means for addressing the lingering results associated with COVID. But all of that said, despite Hurricane Ida being perhaps the fifth most costly natural disaster in U.S. history in terms of insured losses, again, this is something that the industry anticipates. Ida was a major event, no question about it. Earlier in the year, the Texas freeze at $15 billion in terms of insured losses, a major event. Is it the sort of thing that is many people might attribute to climate change? Yes, it is. Is it an unprecedented event? No, it is not. Is it something we will see again and we're prepared for? Absolutely. And so while the industry will bear the financial consequences of this year, the industry's financial integrity is by no means challenged by this. So we get through a year like 2020 with $67 billion in insured catastrophe losses, a year like 2021, where at this point we're probably in the $50 to $60 billion range right now for insured catastrophe losses. We're looking at a decade where we will probably have, if trends hold, $45 billion on an average annual basis in terms of insured cat losses. That's just the new normal. We know it to be the case. Our challenge is to be able to price that risk and to attract the capital to back that risk. And so far, we're doing a spectacular job of that.
Okay. Well, last question, Bob, as we look to the future, where do you see the greatest opportunities for growth in our industry in the year and the years ahead?
Ed, I actually see a huge number of opportunities, both in the property and in the casualty space. Not too long ago, everyone was talking about, in fact, people still do this day. They say, this is an industry that historically made its bread and butter on insuring bricks and mortar. And, but the reality of it is that the challenges of climate change and the challenges of more variability and volatility in the climate and the challenges of a growing global population is that there's more bricks and mortar. There's more people. There's more wealth that's invested in physical infrastructure everywhere around the world. So whether it's bricks and mortar or whether it is wires and data centers, what have you, that challenge remains. So that is a great opportunity for us. It's one of our oldest challenges, but it's one that's going to remain for us as far as the eye can see. I do think that other lines such as cyber, as I mentioned, this is maybe a $5 billion line at best right now. So we're talking about something that could potentially grow by many orders of magnitude over the next several decades. Okay, and there are other opportunities exist beyond the borders of the United States or Western Europe or Japan. We are likely to see in the next decade or so, China become the largest economy of the world. When I was in graduate school, we paid almost no attention to the economy of China, and I'm an economist. So more and more of the risks are going to be coming from that part of the globe or from Latin America and increasingly from Africa. We hear a lot about such things as ESG, environmental, social, and governance-related growth. I think this is going to be, this is an issue that is going to cause us to knock heads with regulators around the world. It's not something that is unmanageable. Insurers have been managing ESG risks since as long as there's been insurers, pretty much. The question is can we somehow come to an alignment with regulators around the world who are trying to use the insurance industry as a bludgeon in many cases to force, for instance, decarbonization in certain sectors. To me, that's another question, and that's a greater challenge, and it's going to be a great challenge to, I think, the people who run trade associations both here and abroad.
Bob, always a pleasure. Thank you for your time and your insights.
My pleasure, Ed. Glad to be here.